All right, good afternoon, everyone, and welcome to our webinar, Growing Your Practice, Insurance Ramifications of Adding a Physician to Your Practice. I'd like to introduce our presenters today, Matt Gracey and Tom Murphy. Licensed as an insurance broker since 1981 in Florida, Matt is an expert in medical malpractice insurance coverage and is the CEO of Danna-Gracey. Tom is an experienced risk management consultant here at Danna-Gracey. He provides physicians and various medical entities with risk and claim management techniques for implementation. I'd like to now turn the reins over to Matt and Tom.
Oh, hi everyone. Thank you, Stephanie. We're very pleased to be presenting today on one of our most commonly asked questions and complex issues of malpractice insurance. We very often get calls from our administrators and our doctors about all the ramifications of adding a doctor to the practice. And it often gets very convoluted just because some of the right questions aren't asked and some of the right information is not gathered. So we wanted to just try to cut through all this and give you some real step-by-step information that is going to really be useful in your process of onboarding a new physician. So one of the first things to ask is of the new physician is what are his or her contract obligations. What happens sometimes is we get into the conversation about retroactive coverage versus tails and all the rest, and we go down this road very far before anyone thinks to actually look at the contract that the physician has with the group that he or she is departing from. So that's the very first thing to do is let's figure out what the obligations are of the physician. Now, as we'll talk later, sometimes those obligations can be very straightforward. Sometimes they can be very complex. But the very first thing is just to get a look at the contract. So get a copy of the contract and then let's look at the obligations. Stephanie, can you give us the first slide, please?
There we go.
What we're looking for is to get what the doctor who's going to join the group is looking at for tail pricing, if in fact they have to buy a tail. There's really two things that you're going to find in an employment contract. When they leave, they're either going to have an obligation to purchase a tail. Sometimes we even see that it's the group's obligation to purchase a tail. Or sometimes they will allow a doctor to carry the retro. Of course, no doctors like to purchase a tail because tails are expensive, and so we often get our administrators or our doctors from the existing group calling and saying, well, you know, gee, we have a new doctor that wants to join us, but they want to move the retro. So then it's always a matter of, all right, let's figure out what the pricing information is. From the old, let's get the tail pricing from the old carrier, and let's get their information on limits and so forth. Particularly coming from out of state, you will find the coverage limits are very different. Often you'll have a 1 million, 3 million, or 2 million, 4 million limit from another state's policy. And in Florida, as you know, many of our limits are much, much lower than that. Most of our limits are much lower than that. So that's always an issue if you're going to bring the retroactive coverage over. And then it's a matter of juggling, okay, what's the price going to be as a first-year claims-made policy if a doctor is going to join the group, and then what is it if it's going to include retroactive coverage. So we put all those pricing matrix together once we gather them, and then look to see, you know, what the best pricing situation is for you to make a good decision. Now, once you get through the contract obligations and then figuring out all the pricing points and differences, there's also a really big factor that comes into play, and that's what's the claims record of the doctor coming forward. And it's one of the things you need to really ask in your interview process, and frankly, often it's overlooked, we find. So you first want to know, gee, what are the claims that are outstanding and ongoing, but then you also, if you're going to consider allowing a doctor to bring the retro from the old practice, you really need to consider what's going to happen if that doctor has a very large claim from his old practice exposure and what that's going to do to your practice's claims record, because it will affect it. Because again, if they join your group's plan and a year later have a big claim that comes in from the previous practice exposure, your group's going to get tagged for that in the claims history. So it's really something to consider. Of course, you're going to have the pressure of the doctor wanting to bring the retro over so that they don't buy a tail, but you need to really consider, is that worth the risk or not? Now, on a claims-free doctor, a doctor's been in practice for years and years with a spotless record, it's not much of a gamble. But if you have a doctor with some serious claims issues and you still want to hire them, then we often recommend, hey, get them to buy a tail from the company that they're insured with their previous practice, and come in with a first-year claims-made policy. Of course, coming in with a first-year claims-made policy into your practice is also much cheaper than coming in on a mature basis, and even a blended rate because of these higher limits in other states. So it really, our first and foremost recommendation would be to get them to purchase a tail from the practice they're coming from, and then come to you on a first-year claims-made basis. But we know that in your negotiations and the difficulty of recruiting doctors, that sometimes just doesn't happen. Tom, you want to
Sure.
go to with the next slide here, Stephanie, and Tom will talk about some of the next issues.
Thanks, Matt. Good afternoon, everyone. The next phase we want to get into here is a discussion on the employee versus the independent contractor. We're starting, obviously, to see much more of this now, especially with consolidation with large medical groups and hospitals and things of that nature. We're not going to discuss the legal ramifications, which are many, and one of the things we always like to do is recommend, and we'll talk about this a little further in the discussion, is that you always consult with a good, reputable healthcare attorney regarding bringing on a new physician or physicians, and whether having them as an employee or independent contractor is more beneficial for your particular practice. However, what we want to talk about today are the insurance issues with this, and typically what we tell our physicians is that there really is not much of a difference from the insurance or insurance carrier standpoint in terms of whether there's an employee or independent contractor. And what I mean by that is, what we're seeing a lot more of, and it's becoming more prevalent because of the changes in medicine and the consolidation, are that physicians are coming to groups with different insurance carriers. A group may have a specific carrier that they've had for some years, and a physician will come as an independent contractor and have a different insurance, and typically ask the group if they can keep that insurance if it's possible. And what we try to impart to our physicians and our groups and administrators is that you really want to try to have the same insurance, regardless of whether it's an employed physician or a contracted physician. And the main reason, there's a few reasons, but the main reason for this is the common defense. This is something that's often overlooked, and very quickly in a hypothetical situation, when if a group brings on a contracted physician, and the physician has a separate insurance carrier than the group has, if there's a claim that comes in and involves that independently contracted physician as well as the corporation and possibly other physicians in the group, there can be a conflict of interest in the defense. And typically what you're going to see is different attorneys, different counsel representing the different physicians since there's different companies involved. This can be a real issue for the physicians as well as the corporation because it creates an adversarial atmosphere that you do not want as a group. So most good healthcare attorneys as well as reputable insurance people will tell you that you want to try to have the same carriers. If you're bringing in a physician, whether they're employed or contracted, obviously it's easier with employed because that kind of is a natural move to have them move on to your policy. Sometimes contracted physicians don't want to change who they're with if they've been with them for a long time. So there are issues there. But in general, you always want to try to have the same carrier to avoid those defense issues when it comes down to a claim. It can wreak havoc actually on the corporation, and as I said earlier, there's a conflict there. So in discussing that as well, Matt had touched on this earlier, you have to look at the policy limits of the physician coming into the practice. Do they jive with what your group physicians have or the corporation has? You always want to try to have the same limits with all of your doctors, and the reason for that is because going back to the claims situation, if one physician has higher limits than the other physicians in that claim, typically they are going to become the target. The plaintiff attorneys are very well versed in this area, and they're looking to go after the big pocket, the deep pocket. And so you want to try to have these things all so everything is in a nice package, whether it's the limits being equal, the being on the same carrier, et cetera. So those deep pocket issues become an issue for the corporation as well as the physicians. And the final thing in this area I wanted to talk about is the corporate protection, which I touched on briefly, and that is making sure that regardless of the situation, because there are going to be times where a contracted physician comes on board and is allowed to keep their insurance coverage. In the current market, we see this because the carriers have actually allowed it to happen. 10 years ago or so, carriers would not allow that to happen. They would say all or none. And so all of the physicians, regardless of contracted or employed, had to be on the same policy and with the same carrier. But that has changed because of the market conditions. And so if that happens in that instance, you want to make sure that not only the group's carrier is aware of the other carrier that the physician comes in with, but that physician has to notify his carrier and let them know who he's now working for, and both have to mention the physician. The contracted physician has to list the group corporation on his policy, and the group has to mention the physicians on their policy, on the group policy. So what you're doing is you're tying up any loose ends and any gaps in coverage, if you will, and what we call, you may hear this term, vicarious liability, responsibility for the liability of others. And so each party wants to make sure, and it's incumbent upon the administrator, the office manager, to make sure that the gap is closed, if you will. So Matt, I'm going to turn it over to you for the next section here for employment contract, and Stephanie, if you could please change the page.
So let's talk about going forward. Once we've gotten through the issues of what the obligations are to the doctor's previous group and so forth, and bringing tail or not, then it's really a matter of how are you going to address the same situation upon the doctor being in your group and leaving. Are you going to allow them to take their retro or not, and how's all that look? So it's really incumbent upon you to get all that down in the employment contract. And I must tell you, it is amazing to us when we look at some of these employment contracts in the wording and how confused some of the wording can be, because no offense to the healthcare attorneys, but they're not insurance people. So what we always advise is, let's have a look, pull out your employment contracts, send us the paragraph, and let us have a look at it, and we'll cut through a lot of the unclear sections. So again, what's the understanding? Who's going to pay the premium? on a year-by-year basis. That's pretty clear-cut. But then what's going to happen upon termination of the employment of that doctor? Are you going to allow him to take his retro, or is a tail required? Again, the cleanest, best way to do it is to require a tail. Again, nobody wants to buy a tail because they're so expensive, but it's really important that you understand that if you allow a doctor to take his retro, that there are a bunch of ramifications of that. It can work out just fine if you have a very responsible doctor and everything's very clearly outlined in your employment contract on what the reporting of his coverage for the next 5 to 8 years might be. But again, you have to get very clear in that employment contract. Tom, why don't you talk about some of the nuances of tails if you allow the doctor to buy a tail outside of the incumbent carrier and so forth. There are issues there. So even the purchase of a tail needs to be outlined very clearly, not just saying, okay, the doctor has to buy a tail or the group will buy a tail for them. You have to really spell it out. Tom, why don't you give us some of those nuances, please?
Sure, thanks, Matt. Yeah, and of course, as you can see by what we've been discussing, there are two sides to this, and the two sides are you've typically got a physician that's bringing on a physician or a group that's bringing on a physician, or that physician that's moving to a group. And so there's going to be different outlooks in terms of what each are looking for or trying to do. And the first thing, as Matt said, we always go back and tell the physicians that you know, before we can discuss all of these options with you and the details, which are very important, you need to look at your contract, at the employment contract. And so obviously a physician leaving a group, they're always going to look for the easiest, least expensive way to separate, if you will. And as Matt had said earlier, with a group, typically, you know, a good healthcare attorney or us, if we get to see their contracts, we're going to advise them to always try to have any departing physicians purchase tail. It's the cleanest way to do it, and it just makes things a lot easier. However, that being said, there are other situations and issues which are evolving and we're seeing grow quite a bit because of the changes in medicine and the consolidation. And so what we're seeing is over the past 10 years or so, we've seen a lot of physicians leaving to go to larger groups or hospitals, and so tails have become a big issue. And with that, the market has opened up and blossomed for the purchase of tails from carriers other than your incumbent carrier. We call them standalone tails. And this has become a big area for physicians because of the need, the demand for it from our physicians out and about. And what has happened is created a bunch of excess and surplus carriers, Lloyd's of London, carriers like this, that have come along, and even some of the standard admitted carriers that now will just offer a standalone tail, even if you weren't insured with this particular company on the base insurance coverage. So it's created options which are a good thing for physicians and for groups because it now provides the opportunity to potentially go out and save a fair amount of money on expensive tails, whereas prior to 10 years ago, the only way that a physician could get tail was to purchase it from their incumbent carrier. And we all know that tails, as Matt had said earlier, are very expensive. So this is something that has actually assisted physicians. And so you have those choices between the incumbent carrier, which typically we will tell our doctors that your best option is always your incumbent carrier. In terms of the cleanest, the best coverage, so on and so forth, that those things are going to be with your incumbent carrier. You give up a little bit of those coverages or the benefits, if you will, of the incumbent tail, which most standard admitted carriers, like the big ones that the doctors are insured with, have what we call unlimited tails. That means that when you purchase the tail, you have an unlimited reporting period. In theory, that is forever. Even if something happens and down the road, the tail can actually protect a physician's assets and after they're long gone. So if that's ever needed. But getting back to the standalone tails, these are carriers that will come in and actually they can be rated by AM Best or the other rating carriers, or they could be non-rated risk retention groups and more risky. The trade-off there is the cost of the premium. Some of these other standalone options for tail can save a physician up to 30, 35, sometimes even 40% on a tail purchase, which can be a lot of money. So they have become a real option for doctors, but when it comes to groups allowing physicians to do this, there's got to be, as Matt said earlier, a lot of discussion, and that discussion needs to be held up front so that these things are not a surprise down the road. One of the real important things with a difference between the incumbent carrier tail and the standalone tail is incumbent carriers, for the most part, in the standard admitted market, there are a number of them that will allow you to pay the premium over a period of time, either a year or 2 years. In the standalone non-admitted market, or what we call the excess and surplus market, these are all you have to pay in full. And that can be an issue when you're talking about a very large sum for a tail purchase, many thousands of dollars. It can be an issue for a physician to pay that in one lump sum. So there is that trade-off of saving the money or premium dollars, but you've got to pay it all at once, whereas your incumbent carrier in the standard admitted market can sometimes allow you to pay it over time without finance charges. So very, very important, very important detail of the difference between incumbent and standalone. I talked a little bit about rated and unrated carriers. That's the trade-off. You typically with an unrated carrier, you're going to get a better premium, but you're dealing with a more risky company, and so that's always something that you have to think about. Also, nowadays, one of the things that these standalone tail companies do is they allow you to purchase different terms of reporting period, whereas we talked about the unlimited tail, which is an unlimited reporting period. They now have options with a lot of the standalone carriers where you can purchase a 1-year tail, a 3-year tail, a 5-year tail, a 7-year tail, and it's obviously another option for physicians. Matt and I have had many surgical physicians that are not worried about a 4 or 5-year tail. They feel that if there's an issue with any patient, that they're going to know it within a short period of time, definitely within a couple of year period of time. So they will purchase the 2 or 3-year tails, and they save a substantial amount of money. So this is an option over the last 6, 7 years that physicians never had prior to that. So it's really important to look into these options, see if they are something that, once again, it's a trade-off. If you're getting less than the statute of limitations in terms of a tail period or reporting period, that can be more risky. So you want to discuss this with your agent or your healthcare attorney to make sure that you're making the right choice and taking the right option. And of course, you always want to protect the corporation, whether it's the physician or it's the group. You always want to make sure on tails that the departing physician, if there's a tail being purchased or coverage being purchased, that the group's corporation is protected either through their own policy that was in force or on the physician's policy when he's leaving, when he purchases tail or moves into a retroactive policy with another company. You always want to make sure that there's no gap in coverage there for the corporation, and it's really important to discuss that detail as well. It gets overlooked just concentrating on the physician coverages. So ending up the conversation here for the tail issues, as you can see at the bottom there, and I've said this a couple of times already, we really, really can't stress enough how important it is to have a really good, reputable healthcare attorney review the contract, discuss your contracts. Before you go into these contracts, you spend a little bit of money up front, you save a lot of money down the road by going through these. And one of the things that Matt and I always encourage our physicians and administrators to do is send us your, the section of your contract, your employment contract, that discusses the insurance and who's responsible and tails. We have enough experience to look at these and tell you and give you some advice as to what we just discussed in this webinar and the direction that you need to go and some of the options that you have. But it's something that you want to try to do up front before it becomes too late. I can't tell you how many times Matt and I go through this multiple times a week where physicians will call after they're leaving or departing a group and they find out that they're required to purchase tail. There are a lot of details they weren't aware of or didn't realize, and it becomes a huge issue and a huge expense for them leaving a group or departing where they're from, and it's not something they were planning for or ready for, and it's a shock to the system. So it's all about the planning up front and looking at these things before they become an issue.
Okay, thanks, Tom. And I think we have time for just a few questions here. We had one question on the retroactive component. If you allow a doctor to take his retro when he or she is leaving your practice, what are some of the ramifications of that? And one of the issues there is really it becomes a kind of a reporting issue. As many of you know, in Florida, the statute of limitations and the statute of repose go out to 4 years for normal cases. For any cases involving children, it goes out to the child's 8th birthday. So a doctor takes their retroactive coverage without buying a tail with them, and then a year or two later decides to go bare. And if you don't require that physician to give you a copy of their ongoing insurance coverage, then you have a empty pocket at the table, as they say, when your practice gets sued, the doctor who's left gets sued, but he doesn't have any coverage, and maybe even one or two of your other doctors get sued in the same case. It just never goes well. So the trick is to build language into the employment contract that says, if we allow you to take the retroactive coverage with you without purchasing a tail, then you have an obligation to us to continue that coverage for the required amount of time and to report to us with your certificate of insurance each year. And then it's a matter of you really having to follow up as well. So it becomes, again, just another one of your duties, or really their duty, but you know how that can go. So let's see, are there any other questions? We're pushing right up against the time limit here, but
Matt, I see one here. It's and it's a very basic and good question, and that is the typical cost of a tail. And what we tell our physicians and administrators is that if you're with a standard admitted carrier, you basically think about a tail price being double of your current, and this is very important, can be either discounted or undiscounted, and it's very important that you look into this with your company or your agent, because that can make a world of difference. Obviously, if you have a highly discounted premium with claims-free credits and society credits, and they base the tail premium off of that, as well as some other things like your retro date and other factors, then that tail premium is going to be a lot less. If they don't, and they base it off of the undiscounted or their base premium, their base rate, it's going to be much higher. But typically, it's generally 180 to 200%, or about double what your current premium is, and that can be changed. That can change. But when you talk about excess and surplus companies, they're typically more expensive. They charge you by the year in terms of your reporting period, and it can go anywhere from 200%, 150%, all the way up to 400 or 500%, depending on how many years you want. But that's a general guideline that we use. And the good news is, as I said earlier, with these standalone tails now, there are options, and we can see that some of these premiums can go down, and we can actually even get some of the standard admitted carriers to compete against those standalone tails and actually lower their tail premiums, which once again is good for our physicians.
Thank you, Tom. Well, we're going to wrap it up. We promised to get you out at 1:45, and we've gone our 30 minutes. And look for more announcements. We're going to have a webinar once a month through the fall and into early winter. So we are very pleased that you joined us today. And if you have any questions, again, don't hesitate to reach out to us, and we're here to help. Thanks again for attending.
Thank you all.
Bye.